Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're well, safe, healthy, smiling, all of that. You know the drill. I low-key feel like every time I show my face on this channel, I look slightly different than last time. Sorry about that.
Pips, bro. We love those weekly uploads. Cheers to the consistency, eh?
Damn, that low-key hit deep. But behave yourself, Kieran. Your section is not until later on in this video. Anyway, I'm sure most of you don't know this. I've actually been spending the past few months here in Toronto. It's been a really interesting year. I got the opportunity to live in Greece for 3 months during summer and now in Canada. And you know, it's genuinely been fun. Meeting new people, doing new things, gaining new experiences, making new memories. And also finding myself a little bit more and reconnecting with who I am on a much, much deeper level. It's true what they say about traveling. It truly is the best way to mature. A lot has actually happened in the past few months as well. There's so much I can speak about right now, but I do not want to make this introduction unnecessarily long. But I actually did have the best trade of my career over the past few months, thanks to GBP USD hitting all-time lows and us holding the sell position that we had running since April this year. I'm sure many of you have seen screenshots of that trade already, as I made sure to update you on a regular basis on my Instagram. And I was quite vocal about having that sell position running for such a long period of time, and also quite vocal about expecting pound dollar to hit all-time lows. And some of you actually messaged me on Instagram thanking me, showing me similar trades that you held open for a long period of time and making a lot of money off of that GU drop. So I hope you're one of those people watching this video. Maybe you guys were the reason for the high interest rates and high inflation rates in the UK right now. Could it be we just emptied out Bank of England? Maybe. Oh, by the way, since I mentioned my Instagram, let me mention it as usual. Be careful of the fake accounts. Always double check the handle. It's just Pips of Persia on Instagram. Forget about any other letter that might change it. People might be very sly with it. They might change just one letter and it might not be easy to see. But just know that I will never ask you for money. It's very simple. Don't send money to people online. I will never ask you for money. And I'll probably always reply with a voice note as well. So you know it's me. You know how I speak. You know I'm not going to reach out to you. So be careful and report all the fake accounts, please. Also, in another news, MetaTrader 4 is not available on App Store anymore. When did that happen? I was quite surprised to actually hear that. It's really interesting. So I know many of you may be looking for like a slightly different trading platform to follow, or maybe you're looking at different brokers. I just wanted to let you know that my friends at Interactive Brokers, which I'm pretty sure you've heard that name before, it's a very big, very well-known broker. They actually reached out to me to let me know a little bit more about their products, and I decided to research it in my own time and realize not only you're getting a lot of good assets that you can trade with them, including crypto, you're also getting very good spreads on them, and not only that, they have their own trading platform, so you don't have to be reliant on MetaTrader 4. So what I'm going to do for you guys is I'm going to leave a link in the description down below. You can click on that link, check out Interactive Brokers, maybe open a demo account or a small live account with them, see how it goes, see how you can trade with them. I'm sure a lot of you would love to continue your trading journey with them. And just to quickly mention one more thing before we get into the video today, I know a lot of you are looking at a lot of different companies for proprietary funding. You're doing a lot of different tests with different platforms for you to actually get access to the funded accounts. Just to let you know, I've came across a new prop firm by the name of Funded Next. Again, I'll leave the link in the description down below so you can check it out in your own time. And the way that they were giving the accounts, the way that it was priced, and the way that you could do the retakes was extremely attractive for me. So I didn't want to just keep this information to myself. Obviously, I'm going to let you guys know. I know a lot of you guys are after these type of accounts. So if you wanted to know more about Funded Next as well, just click the link in the description, have a look through their website. And maybe at some point in the next few weeks, we'll do a couple of giveaways for the accounts of Funded Next. We'll see how that goes. We'll keep that for a different video. But now going back to the topic at hand. In the video today, we are going to be finally discussing imbalances. I know this is a topic that many of you were confused about for the longest time. Maybe you've watched many videos on YouTube and you still are unsure how to implement that into your trading. So what we're going to do in today's video is we're going to break down imbalances from A to Z. We're going to go into some detail about what it is, why it's formed, how or if you should implement that into your trading. This practically will be the only imbalance video you will ever need. I might release a more advanced imbalance video later on as well, but we're given a lot of phenomenal information in this video, which I'm sure will be helpful to many of you. So without further ado, let's start with some basic definitions.
Similar to a lot of the concepts that we are using these days to trade Forex, such as Wyckoff schematics, that term, an imbalance of orders, was first used in stock analysis by stock traders. And it describes a situation where there had been too many orders of either buys or sells at a given period of time and not enough orders to counter it. In a way, it's important for us to understand that there needs to be a balance between the buyers and the sellers in the market. And when there is not not a balance when we observe an imbalance, it simply means there either have been too many buyers at that given time or too many sellers at that given time. Within Forex, we consider an imbalance to be an area in price where we have observed an impulsive move in one direction that showed us at that given time there was more orders on one side of the market and not enough on the opposite side. There are some other words that you may be more familiar with when it comes to imbalance, such as gaps or inefficient price action or inefficiency. Just know that all of these terms are speaking about the same concept. You always need to think of the market as this balanced seesaw or like a balanced scale where there needs to be a balance between the amount of buy pressure we have in the market and the amount of sell pressure that we have in the market. However, from time to time you will be able to see more buy pressure or more sell pressure, and when you end up observing more orders in one direction, for example there is a lot more buy pressure in the market, that will result in gaps, that will result in the market impulsively going up because there isn't much resistance from the sellers. There's just power being pumped into the market from the buy side. There isn't much resistance on the sell side, which means the market is free to move impulsively in one direction. Now, how you can spot imbalances on the charts is much easier than you think, but how to actually and properly, correctly use imbalances may not be as straightforward. Let's talk about identifying it on the charts first. Let's think of the candles on the charts as if it was a chain. Within each chain, these small little pieces are well connected with each other, making the whole structure. But it goes without saying, if there is a lot of pressure pulling this chain apart, the chain is going to break, is going to have gaps in the chain because there's been too much pressure on the chain, too much pressure in one given direction. On the charts, during a time that we are seeing healthy price action, we also need to see a similar relationship between each candles and the wicks as we did in the previous slide with the chains. In these examples over here, you can see how, for example, the wick of this candle is well connected to the wick of this one, like a chain that is connecting very well, or the wick of this candle is well connected with 2-3 candles after it. There's a little gap over here, but the market ended up coming up and filling it in. So we can consider that also well connected. You can see that the wicks are very well connected with each other. It's as if the market is going in one direction in a very healthy step-by-step process, and the wicks are touching each other. The wicks are connecting with each other, right? Even when you look at it this way going up, it's the same story. You can see that the wicks are connected. You wouldn't be able to see a lot of gaps or any gaps that haven't been filled. The wicks are all connected. Regardless of whether you're looking at a small picture or the larger picture, for example, over here, the wicks are all connected. It's a very well connected chain going in a given direction. But when you see an imbalance, it's as if the pieces of the chains, or in this case, the wicks, are not connecting with each other. This is what an imbalance looks like. You can see from this wick over here to, for example, this wick over here, we don't have any connections. It's just the body of the candle. So that's point number one. When you identify an imbalance, you identify it on the body of a candle. And point number two is you identify it at a range where the wicks have not connected. So this gives us an imbalance right over here. Let me quickly change the color of this to something much easier to see. This gives us that area of imbalance that we are working with. Again, you can continue with this structure over here. You can see how this wick is kind of well connected to this wick over here, whereas this wick, I'm not seeing any connection with another wick. And oh my God, it's just the body of the candle. There is no connection. It's as if there is a gap between the wicks. So that gives me an area of imbalance there as well. Vice versa with the other structure that's going up over here. You can kind of see, for example, in this section, this wick is very well connected with this wick. And you can kind of see the areas that I'm highlighting, right? I'm considering one wick with not the candle after it, but the candle after that. And they are kind of very well connected. There's no gaps between the wicks. But on the other hand, this wick and this wick are not very well connected. Between them, I can draw a box that wouldn't actually highlight any area other than the body of the candle in the middle, and there are no wicks coming into this area. Same with this up here. This is yet another imbalance. You can see that the wicks are not connecting. There's a gap between the wicks, and I'm highlighting just the body of the candle. This is how you can identify an imbalance. You can see that the wicks are not connecting, the chain is kind of broken, and it's as if there is almost a gap over there. And in this case, the gap will be the body of the candle. Sometimes you might have seen after a new week starts, there's a small gap in the charts. For example, Friday has closed the market there, but Monday has opened the market up there. This gap in itself, the new week gap, we can also consider that an imbalance as well. That's exactly what has taken place. It's basically telling us within this range, within that area, there was way too many buy orders, and even a little while after that, there was still so much power on the buy side and not enough resistance on the sell side, which means the market didn't have time to come back down, to close this imbalance, to connect the pieces of the chain well, and just continued rallying in that direction. Same story over there. This is how you spot an imbalance. Now, long story short, the most basic description of how imbalances are perceived by traders is the market needs to always rebalance itself. Like the seesaw or the scale that we were talking about, there always needs to be an element of balance. So when we observe an area of imbalance, a lot of traders' mind instantly goes towards, hey, we need to rebalance the market, which means at some point, the market will come and revisit that area of imbalance to rebalance the market, to fill in their orders. Again, going back to what I was saying earlier, when a new week starts, sometimes you can see gaps in the price, but 9 out of 10 times, if not 10 out of 10 times, that gap will be filled. It's the same story over here. It's an imbalance that's going to get filled. It's a gap in price that will be filled, simple as. So the market can be perceived to be pulled towards areas of imbalance to then rebalance the market. And we would consider an imbalance closed as long as the market kind of comes and punches into that area. We don't have to fully see the imbalance fully closed to the very top of it, for example, over here. Even if it pushes around, let's say, halfway through, we are happy and we can consider that imbalance closed. We can consider that area of price that was showing imbalance, that was showing gaps, to now have been filled and for the market to have regained its balance. Before we go any further, I would like to heavily emphasize the word basic here. I said this is the most basic description of how traders perceive imbalance, because there is a lot more that goes into imbalances. It's not just, hey, you see an imbalance and the market is magically pulled towards it. No, like any other concept that you have learned on this channel, we need to be using them with other confluences, as we will discuss later on in this video and the next ones. But before that, let's spend a couple of minutes getting our eyes trained to spot imbalances on the actual charts. We'll do a few quick examples on the markets going up and a few quick examples on the market coming down. Again, remember, we are looking at areas that the wicks are not connecting well. So technically speaking, this over here, we can consider this an imbalance. Within that candle, within that period of time, this was an area of imbalance. The market didn't punch it. In fact, started to create some liquidity right above the imbalance, started to go a bit higher, later on came in, filled the imbalance, so rebalanced the market while it took liquidity and then continued in its given direction. Oh, we have another area of imbalance right over here as well. You can see that these wicks are not connecting. What was our definition of imbalance? We are highlighting the body of the candle and when the wicks are not connecting. So surprise, surprise, that's another imbalance over there. Later on, the market kind of punched into it to rebalance the market. Again, this is another imbalance right over here. Wick to wick, identifying the area of the body of the candle. The market came into this imbalance and filled it in. We can also find examples of imbalances being filled on the opposite direction going down. For example, this is a very big imbalance right over here. You can see that between this wick and this wick, we haven't seen any connection while that was being formed. Later on, the market came back up, punched in the imbalance, filled it in, even went higher, and then continued to go down. In this case, well, it consolidated and went up, actually. I thought it continued to go down. Again, we can look at more examples of imbalances. This is another imbalance over here, an area of price where you can just see the body, wick to wick, you're connecting it. This is the market coming back in and rebalancing the market. And this is another imbalance over here. This is another imbalance over here going up. All of these are imbalances. And you can see imbalances kind of everywhere on the charts, right? You can kind of see them left, right, and center on the charts. I'll be honest with you. There are so many of them. Even if you look at, well, if you look at any time frame, you can find imbalances. You can find small imbalances like these. You can find larger imbalances like the one that we just identified over there, or even this big imbalance over here. You can see that imbalances are kind of everywhere on the markets, everywhere on the charts. But based on just these few examples that we've highlighted in such a small period of time, such a short period of time on the charts, you know, there isn't too much consistency with how we can use imbalances. Yes, over here we closed it and continued in that given direction. Over here, it didn't exactly come halfway through or the full closure and then continued to go up. Okay, maybe we wouldn't have been able to trade it. Over here, we closed it, but it didn't take the high. It ended up coming back down. Okay, these are like 3 different imbalances with 3 different trading scenarios in a short period of time. Over here, it punched above the imbalance and then went lower, unless you would have just been trading this from here down, for example, for that 1 or 2 hours, 1 or 2 candles. Another imbalance that I didn't highlight is one that we have right over here. Again, for this imbalance, you can see that it kind of punched below the imbalance. It closed the imbalance and went even lower and then continued to go up. In this small imbalance over here, it closed it, but then after that, it didn't really do much. Over here, it just punched straight through it and closed it as it was going up. Over here, it closed it first, went up, came back down, closed it fully, and then continued to go up. Over here, it kind of, I guess, closed 50% or so of the imbalance and then continued in that direction. You know, we looked at a handful of scenarios, and all of these scenarios would have needed different trading rules, would have needed different trading approach, would have needed you to be looking at much more than just an imbalance for you to define both your direction and your entry. So I don't want you to just learn a new concept or learn a couple of new things and instantly apply it to your trading. First, this is just us getting our eyes used to seeing imbalances. First do that. First get your eyes used to identifying imbalances and how to draw them, where to draw them. And obviously understand that the bigger the imbalance, the more important it was, because there was more orders being created. The market moved more aggressively. But yet again, this is another example of an imbalance where the market filled it in but continued in that direction. All of these scenarios will have different trading patterns, different trading approaches, different trading rules. I say that to say one thing: don't take imbalances as gospel, as this magical word or this magical concept that's going to completely elevate your trading. Sometimes traders look at imbalances with the attitude of, hey, that imbalance needs to be closed, therefore I will trade in that direction. Well, you're not wrong. The imbalance can be closed, but it can also take a very, very, very long time for that imbalance to actually be closed. Let's say you have this imbalance over here. Consider this one, right? I'm just gonna draw this, and actually we'll extend this kind of indefinitely a little bit for now, just so we can see it much easier. For reference, this imbalance was created on 13th of September 22, right? Look how long it took for this imbalance later on to be closed, for the market to come back and actually go inside of that area. That's 27th of October 22, right? So that is, what, a month and a half since that imbalance was closed. Exactly, yeah, 43, 45 days, let's say, right? So that's a month and a half until that imbalance was closed. The mistake a lot of traders make is, hey, we have an imbalance over there. The market needs to go and fill in the imbalance, therefore I'm going to be trading in that direction. Imagine seeing the chart when, for example, it was right around there. You wouldn't know what's going to happen after. You would expect the market to at some point come back up and maybe grab liquidity above here and fill in the imbalance. And that entices so many traders to start looking for buy opportunities somewhere over here. And look how wrong they would have been. They would have missed out on a beautiful sell to the downside and maybe constantly would have just been looking at buy positions because they think to themselves, oh my God, we had a distribution looking behavior over there. We had an imbalance. Therefore, the market needs to go in that direction to close that imbalance. The main issue with identifying imbalances as a direction defining factor is that it will give you a bias on your trades before you even analyze the charts. And to me, that makes no logical sense. I don't know about you, but why should we even have a bias before even analyzing charts properly? That's where traders are constantly thinking to themselves saying, oh my God, there's an imbalance, therefore it's going to go up, therefore it's going to go down, I'm going to trade in that direction. That's false.
That's wrong. We should not do that. But having said that, that doesn't make imbalances purely useless, because at the end of the day, we are able to use imbalances next to a lot of other factors to help us with our trades. You know this already. Nothing is straightforward when it comes to trading. Nothing is straightforward when it comes to Forex. So we always have to use a group of different things for us to then be able to get to the desired solution, which is being profitable on the chart. But I know you're probably bored of my voice. So what I'm going to do is I'm going to stop talking. I'm going to pass it over to someone who has spent a lot of time back testing imbalances and is also a phenomenal trader. So Kieran, my bro, take it over and tell them why we shouldn't be using imbalances to define direction.
As Pips literally just explained, we are not using imbalance for directional biases. And here's why. Right, if you take a look on the screen, we can see clearly so many examples of imbalance. Right, we've got imbalance here, we've got imbalance here, we've got imbalance here, we've got imbalance here, we've also got imbalance here as well. Now, if we were using imbalance for directional bias, what we're going to be saying is, oh my god, because we've got this imbalance, it must be filled immediately. But that is nothing further than the truth. All we know here is that at one point in time, there was more sellers than buyers. There was more sellers than buyers, more sellers than buyers. But it doesn't tell us that the imbalance has to be filled just yet. I mean, there's so many other tools that are so much better for directional bias. And maybe, hey, Pips, I mean, how many likes would we need to see to do a whole video on directional bias?
Oh, you're asking me difficult questions now, bro. Let's say 2,000 likes. If you guys want to see us in two more videos, breaking down direction analysis and imbalance in much more detail.
So how do we actually implement these imbalances in our day-to-day trading? So remember, we're not using it for directional bias because specifically all this imbalance over here, which you can see, right, from here to here, just like Pips explained, all it is showing us is that in this old piece of data, there was more sell orders than buy orders. That's it. There is no mitigation occurring. There is nothing else happening apart from them just matching on their order books and then writing down saying, okay, at price, for example, £10, you know, we had 1 million orders that were sold at this price point, and now we have 1 million orders that are brought at this price point. That's it, right? Because when price comes back to this in the future, which yes, it can happen, how do we know if the market is going to continue lower? Or how do we know if it's going to come to this area and actually blow straight through it? Well, that's why we have to look at other pieces of confluence for our directional bias, such as supply and demand, such as market cycles, etc., etc. And we need to use other levels for our entries. Now, again, this video isn't all based on directional biases, but let's take a look at how we can actually now implement this. So for me, when I implement this in my trading, all I use it for is refinements and potential targets that follow my original bias. So let's say we come to the market, we've done all our other technical analysis, we've determined this is a bearish market, you know, we've now determined, okay, here's an institutional candle, right? But the question is, where do we enter off the institutional candle? You know, a lot of times, some people enter, you know, off the open, sometimes they'll go and measure it, maybe enter off to 50%. But the question is, why does sometime price come to our level, sometimes react straight from the zone and drop? Why does sometimes it come higher into our level and then react? Right? How do we get more precise and how can we avoid drawdown? Because if we can get more precise and minimize our drawdown, that's going to increase our risk to reward, meaning we'll be able to make a lot more money and be more precise. Now, bear in mind, the more precise you get, that you do run the risk of not actually getting filled in your trade, but this just comes down to what's worth it for you. For me, I'm happy to miss a couple trades that have a much better risk to reward and I can make a lot more money on, compared to being in more trades that I'm going to make less money on. For me, I want to trade smart, but not often. Again, let's just compare the two. So if we use our traditional, you know, institutional candle, enter off the low, you know, let's say stop loss above the high, and then let's just say we're targeting this low, right? So that would give us a 1 to 7.8 risk to reward. But if we now dive into this area on the lower time frame and see what is lurking inside of it, and when I zoom into these lower time frames, what can we actually observe? What can we actually see? I'm seeing, so again, our supply zone starts at this black line. I'm already seeing imbalance up to here. I'm already seeing imbalance up to here. I'm already seeing imbalance up to here. Again, if you can't see it, I'll just quickly highlight it for you. Imbalance from obviously these lows to here, imbalance from here to here, and imbalance from here to here, just like Pips explained. So if we now use, right, these refinements. And for me personally, I would like to see the imbalance get completely filled for me to take a trade. Yes, on the short term, you can consider if it does come to the 50%, it is filled. But for me to have a complete fill, I want to see the whole thing get filled. Is because, remember, on their order books, each price point, they're going to have the amount of buy and sell orders that happened and that were traded through those levels. In an ideal environment, at each price point, they want it to be equally traded. That's why obviously they'll come back and fill. I want the entire imbalance to get filled. So if I've got this imbalance now inside my higher time frame supply zone, I can use a full imbalance fill as an entry inside my supply zone. And now if we use the same stop loss, we've now reduced the stop loss from a 59 pip stop loss to a 23 pip stop loss. And if we now have the same targets, just by using this refinement, we drastically increase our profitability from a 1 to 7.8 risk to reward to now a 1 to 21 risk to reward. Price comes up, we fill our imbalance. Now, yes, we have a little bit of drawdown, but now we only have 5 pips compared to 46 pips. Much rather, miss 1 or 2 1 to 21s, catch a 1 to 21, instead of taking 3 or 4 1 to 7s to make the same profit. And we play her out. And what does she do? There she goes. She obviously goes to our objective. But where is she going to? We can also use imbalance for target. So let's just say we understand we've got this liquidity resting below this low. It can increase the probability of your liquidity playing out if there is some imbalance below it for price to come and fill. So if we look left, I'm about to blow your mind. So let's just put a line on this low and see if we can build confluence. If we can look left and keep going left, look where price comes into. There is imbalance, and the blue line was the low. There is imbalance below here. So there's a reason for price, and I'm zooming a little bit more. There's imbalance here, if you can see it. There is a reason for price to come now and fill this imbalance and also take that liquidity. And if we actually keep playing price out, she eventually comes and fills our agenda. So you could have extended your target now, going from that 1 to 7, you're now extending it to a 1 to 10, or your 1 to 21, now towards a 1 to 29. So again, remember, when it comes to imbalance, it's an important concept 100%, but you have to know when to actually apply it. For me, when I go to the chart, the first thing I'm not going to do is come to a blank chart and say, oh, there's imbalance here, there's imbalance here, so I'm going to start buying because it has to fill there. Well, no, we literally just discussed there's so many other tools that are more important than that just being the only thing that's going to come to our trade idea. So again, just to recap, guys, when it comes to your identifying your imbalances, yes, go train your eyes to it. Go see it play out again and again and again. But see if you can add the new things that you've learned today, and then definitely post us on your social media and show us the new trades that you've been able to get, and we'll definitely repost you. Because again, all the market's going to do is just fill orders. Because if you're looking at the market and thinking, oh, there's imbalance up here, right, and it has to fill there, well, that's nothing further from the truth. Because what if it just does this? How do you explain that? Now, when you start to understand true supply and demand, you realize that the only reason they didn't fill this imbalance was because they managed to get all of their orders filled at this price point. Like Pip said at the start, right? The market has to have one buy order to match one sell order. So they managed to find enough orders that were available at this area here for them to complete their overall agenda. So for me, when I'm actually trading now on a day-to-day basis, I'm not always using imbalances, like I said, for directional bias. I use more supply and demand zones and actual levels where institutions are entering their trades in Wyckoff. Because again, if you're just using this imbalance, right? And you're saying, oh, okay, let's say at this point in time, oh, there's imbalance up here, it has to get filled. Well, I'm looking at the market slightly different. I'm seeing this market is a bearish market cycle, and we've just introduced supply by redistributing, introduced more supply by redistributing, and introduced more supply by redistributing. So if the market doesn't have an agenda to come back up to fill the imbalance, they don't need to. But I guess you could ask yourself the question, well, why would they fill imbalance? The reason why they would fill imbalances is because they need to get more orders filled. What do I mean by that, by filling orders? Well, at each price point in the market, there's going to be different levels of orders that are available. And obviously, the higher you go, the more orders that are physically available for them to sell. Like Pip said at the start, it has to be 1 for 1. It has to be one buy order for a sell order. It Has to be one buy order for a sell order. So if they can get all of their orders filled at a certain price point, for example here, they managed to fill all of their orders at this level here, so there was no need for them to bring it to higher pricing. Because let's say at this point here, it costs 1 million orders to drop price lower, and there's 1,000,001 orders at this price point, and they get all 1 million orders filled, there's no need for them to go higher. So what are they going to do? Are they going to bring it higher just for the sake of it to fill your magical imbalance? No. All they're trying to do is fill their orders. So once they fill their orders, the market's going to continue. But I guess that leaves the question with how do you know if they're going to fill their orders? Well, that is a conversation for another day.
And we will most definitely go into more detail about that in a future video as long as we hit the likes target. But I want to just leave you with this, a little mind-bending fact just to get you motivated enough so you spend a lot of time backtesting this. And this is very similar to the final example Kieran was showing. In this case, where would you identify your imbalances? It would be very correct to say you have an imbalance there and you have an imbalance here. But what if I was to ask you, where would you identify a drop-based drop formation? Where would you identify an area of redistribution? Of course, you're going to be highlighting the exact opposite area. In fact, you're highlighting exactly the area in the middle of both of these imbalances. Isn't that interesting how supply and demand is speaking about slightly different zones, or if you want to push it, a complete opposite zone to imbalances? What does that mean? Is that giving us more information or less information? Is that helping us or confusing us? Is this something that we should worry about and not know whether or not we should use imbalances, or should we consider imbalances and drop-based drops both together? This is where I want you to go and spend some time to backtest the objectives with an imbalance. Exactly what Kieran was speaking about. It's your independent backtesting, your independent research, and your independent practice that will create an independent trader. Don't expect to be spoon-fed everything. We are here to open your eyes and open your minds towards different questions that you can ask yourself that over time will help you have a much better understanding of the market. But with that being said, if you got value from the video, don't forget to press the like button down below. Let's hit the like target, and don't forget to check the description for more information about interactive brokers or Funded Next. Kieran and I have got a lot of good videos planned for you guys over the next few weeks and a special Christmas surprise. So enough promises, enough talk about the future. We're just going to execute, and you're just going to see what is going to happen in the next few weeks. Keep on top of my channel, keep on top of Kieran's channel. Make sure you have the notifications on, and we shall see you very, very soon. Let's elevate and let's catch some pips.